Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, if you're in the world of crypto ETFs, listen up. The IRS just made a move that could seriously change the game for your investments. We're talking about a new rule that could turn your ETF into a source of regular income. This is a big deal. So let's just cut right to the chase. What if your crypto ETF could start paying you, almost like a stock dividend? Well, that's not a what if anymore. It is now a very real possibility, and we're about to break down exactly how this is all going to work. So here's our game plan. First, we'll dig into what the new IRS rule actually says. Then we'll unpack the huge tax headache it's designed to solve. We'll look at how this new safe harbor is basically a green light for funds, and then, the important part, we'll weigh the big wins and the potential trade-offs for you, the investor, before we get to the final bottom line.
Okay, so what's all the fuss about? Well, the IRS has just put out a new rule, and it's aimed squarely at crypto ETFs that use something called staking. You know, that's the process of locking up crypto to help run the network and earning rewards for it. And believe me, this update is a real game changer for anyone invested in this space.
The official name, if you're curious, is Revenue Procedure 2025-31. But what it really does is create something called a safe harbor. You can think of it like a pre-approved safe flight path from the IRS that lets crypto ETFs generate that extra yield from staking, but without flying into a storm of tax problems.
Now, to really get why this safe harbor is so important, we have to rewind a bit and look at the massive problem that existed before this rule. A problem that, honestly, cast this long shadow of double taxation over the whole industry.
See, up until now, if an ETF wanted to get into staking to earn rewards for its investors, it created this giant, scary tax issue. And this risk was so big, so uncertain, that it basically stopped funds dead in their tracks from even trying to offer staking rewards to people like you.
Okay, so here's the heart of the problem. For tax purposes, an ETF wants to be seen as an investment trust. Its main job is just to hold assets, right? Which means there's only a single layer of tax when you, the investor, get your payout. But staking, well, earning rewards, that looks a lot more like a business entity, something that's actively trying to turn a profit.
And that, right there, was the big fear. The nightmare scenario was that the IRS would look at a staking ETF and say, nope, you're not a simple trust, you're a business. And if that happened, wham, the ETF itself would have to pay corporate taxes on its rewards, and then you would get taxed again when you got your payout. It's a classic case of double taxation and an absolute disaster for returns. So, this is where the new rule swoops in to save the day. The IRS has finally provided a clear rulebook, this safe harbor, that basically gives ETFs the green light to offer staking without that terrifying reclassification risk.
So what exactly is a safe harbor? It's just a set of guidelines, a checklist. If an ETF follows these rules perfectly, the IRS guarantees it won't get hit with that negative tax outcome. It's all about providing certainty in a very uncertain space.
So what's in this new rulebook? Well, it's pretty much all about investor protection. First, the ETF has to be the real deal. SEC regulated, publicly traded. It can only hold cash and a single kind of crypto, no weird mixes. Crucially, it has to protect you from something called slashing penalties, which is when a validator messes up and loses funds. The ETF also has to keep a cash reserve so you can always cash out when you want to. And finally, no risky business. It's forbidden from chasing crazy high yields, and it must pay out your rewards at least every quarter.
Okay, so we've got all these new rules. What does this actually mean for you? Let's talk about the big wins, the real upside for you as an investor.
The biggest win, by a long shot, is tax certainty. You remember that whole double taxation nightmare we just talked about? Well, for any ETF that plays by these new rules, it's gone. Wiped off the map. And that is a huge, huge relief for everybody involved. The second major benefit here is risk protection. You know, if you try to stake crypto on your own, you're taking on some serious technical risks, like that slashing thing. Well, under these new rules, the ETF has to shield you from that. They take on the risk. Plus, that liquidity reserve means you never have to worry about getting your money out. Basically, the fund manages all the technical headaches for you.
And all of this leads to the most exciting part for a lot of people, stable income. For the first time ever, you can hold a crypto ETF and actually expect to get a regular payout, like a dividend check, at least 4 times a year. This completely changes the game, adding a whole new income dimension to crypto investing.
But, of course, nothing is perfect.
all this safety, all this simplicity, it comes with a price. There are some really important limitations, some trade-offs that you absolutely need to know about. This slide really lays it out perfectly. On one hand, you have ETF staking under the new rules. The yield is probably going to be more conservative, but your risk is super low because it's all managed by the fund. On the other hand, you can go stake on your own. You could potentially earn a higher yield, sure, but you are taking on all the risk and complexity yourself. It's a classic choice, simple and managed, or complex and high risk.
So let's just hammer home the key trade-offs. First, your returns will likely be a bit lower, because remember, the ETF is not allowed to go chasing the highest, riskiest yields out there. Second, you'll have less variety. This whole safe harbor thing only works for single crypto ETFs for now. And third, the rewards have to be paid out to you. That's great for income, but not so great if your strategy was to automatically reinvest everything for that sweet, sweet compounding growth.
So, after weighing all the pros and cons, where does that leave us? What's the bottom line for you, the investor? Is this actually good news?
Well, the analysis out there is pretty clear, and I think this quote really nails it. For investors, this move by the IRS is seen as very positive. Why? Because it just removes some of the biggest obstacles, the tax fears, the technical risks, the sheer complexity of it all, right off the table.
Ultimately, what this rule does is it creates an entirely new category of crypto investment. It's a product that's designed to be safer, way more accessible for the average person, and one that prioritizes stability and income over trying to hit home runs with maximum returns. It really opens the door for a whole new type of investor.
And that leaves us with a final question for you to think about. The IRS has now drawn a very clear line in the sand, giving investors a real choice. So, looking at your own strategy, what makes more sense? Do you go for the managed, safety, and stable income that these new ETFs will offer, or do you prefer the higher risk and potentially higher rewards of going it alone? The choice is now yours.